Welcome to another episode of Taking Stock for the week ending the 20th of February 2026. I'm Kien, Head of Research at Stock Doctor, and joining me today is Matthew Swartz, our Senior Portfolio Manager. How are you, Matt, today?
Yeah, very well. It's been a busy week, hasn't it, Ken? But by and large, from what I can sort of see with regards to many of our style stocks, quality was on show. So we've had a pretty good week.
Yeah, great to see some of those tech stocks really recovering this week. But before we begin, just a quick reminder, the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures aren't a reliable indicator of future returns. Well, Matt, we're now past the halfway mark of reporting season, and overall it's been quite an upbeat week for our star stocks, and that's despite strong employment data, which raises the risk of another rate hike. But the news didn't really impact markets, did it?
No, it didn't, Ken. And look, fortunately, I think investors are really very focused on reporting period, which is the way in which we like to see things.
Mm.
But look, although rising rates are generally considered to be a net negative for economic growth, there are certain industries that do benefit from these type of conditions. Take, for example, the banks. They'll likely see stronger net interest margins, and this has largely been confirmed this week as the banks are posting their quarterly updates, where net interest incomes have come in better than expected. NAB, for example, reported cash earnings of about 2 bill, up 16% year on year, and the net interest margin did improve 2 basis points to 1.8%. And bad debts remain very low, which you'd expect in an environment where we are observing strong labour data. Importantly, the quarterly run rate suggests NAB is tracking ahead of its first half 26 estimates.
It's great to see that. And the other major banks are also doing quite well. But the only outlier was Regional Bank, Bendigo and Adelaide Bank. Although the result bet expectations, I think investors here are concerned that regulatory costs could increase from here, while capital levels may be too soft to help it restore mortgage growth back to the industry average by mid-year.
Yeah, that's right, Ken. And that's why the market just isn't prepared to pay a high multiple for the regional banks. And thus, it does trade on a far more attractive dividend yield compared to the majors. But nonetheless, we do see the dividend per share as being sustainable. So speaking about financial challenges, the insurers are also facing some pressure this week. Suncorp reported softer insurance premium growth of just 2.7%, which was below expectations. And they also did lower their full year gross written premium guidance to the bottom end of its mid-single digit range. And this has contributed to the negative earnings revisions.
Yeah, that's been a key theme among the insurers, the softer premium environment. That's also flowed through to those insurance brokers like Steadfast and AUB Group as their commission growth is linked to premium growth. In addition, you've got sentiment, which remains quite weak on these stocks due to concerns that AI platforms, they could replicate their business model, but we'll talk more about that later on.
We will. It's obviously a very hot conversation going on in markets at the moment. But in contrast, the health insurers are benefiting from recent premium increases, which support earnings and dividends. So Medibank reported this week, the result was slightly softer at the profit line, but this was due more to lower investment income and higher costs. But despite this, they have increased their dividend by 6%, which will now yield dividend of about 4% per annum. So the stock goes ex-dividend on the 26th of February.
And across to the other financials, Matt, the wealth platform providers, they continue to produce stellar results. Netwealth, they outperform expectations despite reputational concerns linked to their First Guardian collapse. And performance was driven by stable margins and higher interest earned on client account balances. However, underlying net inflows were softer than Hub24. And outside the financials, the retails, they remain a mixed bag. You had JB Hi-Fi. They delivered quite a quality result, slightly ahead of expectations, and that was supported by solid performance from the good guys and also strength in their electronics area. Universal Stores, on the other hand, also impressed with the first half net profit around 7% ahead of expectations, and there was strong second half trading so far. So that includes the like-for-like sales growth of around 7% in the first 7 weeks.
But Lovisa, however, did disappoint. First half like-for-like sales of just 2.2% were below the market's expectations. And unfortunately, the first 7 weeks, as they updated the market for the second half, showed like-for-like sales of just 1.6%. The key issue here was a 5% decline in the ANZ segment, Australia and New Zealand, where competition in the fragmented low-cost jewellery market has intensified.
Yeah, but outside of that, I think one of the other retailers that did quite well, and we transitioned was Breville. We transitioned Breville to borderline star growth stock as its return on equity has declined to around 13.5% below our 14% threshold requirement. Now, that said, though, it remains a high quality retailer. It's navigating tariff headwinds by shifting production outside China and also lifting prices selectively and focusing on those higher margin retailers. So they are doing quite resiliently.
Yeah, that they are, and management guided to slightly higher underlying earnings year on year versus flat expectations from the market. And speaking about positive earnings revisions, A2 Milk upgraded their full year guidance despite lower birth rates in China.
Yeah, this is an interesting one, Matt. Market sentiment has been quite weak, but they've been able to achieve this through premium positioning, market share gains, and diversification beyond infant formula, including strong growth in broader nutrition products. Execution is offsetting those demographic headwinds for now.
And moving across to another upgrade, Technology One. They've been under a huge amount of pressure to a conversation we're going to have later in this segment, and it was largely sort of due to governance concerns and AI disruption. But it was a modest upgrade to the full year 26 profit guidance to 18 to 20% growth.
Yeah, and overall, as we've mentioned, Matt, it's been a constructive week, solid earnings delivery, supportive dividends, and resilience despite ongoing rate uncertainty. So please refer to our corporate calendar to keep on top of the announcements. For Under the Microscope, let's turn to Spark New Zealand, a star income stock that has been under pressure over the past year as investors question its debt levels, negative earnings revisions, dividend sustainability. Remember, Spark New Zealand is a big telecom in New Zealand. So did the first half 26 result ease those concerns?
Yeah, I think it did, Kien. Operationally, the result was, from our viewpoint, quite steady. Revenue did dip slightly, but underlying earnings rose by about 5% and free cash flow did improve. And mobile revenue grew 1.6%, which was driven by a higher average revenue per user, and cost savings has continued. Importantly, management have reaffirmed full year guidance for 26, which was a relief after what has been a quite difficult period for shareholders.
Yeah, it seemed quite positive, Matt, but the market didn't like it. But it seems that the market appears uncertain about its outlook. Service management revenue in IT remains weak, and broadband connections continue to decline amid strong competition. So I think that's where the market was focusing on. While mobile is holding up, investors are cautious about how sustainable that growth will be.
But regardless, we do see the dividend as sustainable on the back of strong free cash flow generation, which should cover the dividend payment this financial year. Sparky is trading on an unfranked yield of around 8% going into its ex-dividend date on the 19th of March.
I noticed also on Stock Doctor, the payout ratio is still quite high. And just to clarify, even though it's above 100%, that's not the best measure for capital intensive telcos like Spark. Earnings include large non-cash depreciation charges. What matters is free cash flow, as you mentioned, Matt. Dividends are now linked to 70 to 100% of free cash flow, with annualized DPS currently at 16 cents per share. That's in New Zealand dollars, and that's looking more realistic. Note that this is slightly different to the value in Stock Doctor due to that New Zealand dollar currency conversion.
And financial health should remain strong, with debt trending lower following asset sales. The key catalyst from here would be clear evidence of an IT recovery. They are trading at a significant discount to fair value with a high yield. Spark, to us, do remain appealing for those that are patient.
And now, with growing concern about AI disrupting software providers, the key question this week is whether AI will materially impact the earnings profile of some of our star stocks in this space.
This is the million-dollar question going on at the moment, isn't it, Kien? And look, businesses most at risk to this dynamic are ones that are built around user-friendly interfaces, bundled tools, comparison sites, or heavily customized workflows that AI can now replicate. More resilient companies tend to own proprietary data, operate in regulated environments, embed transactions into their platforms, and do act as a system of record that is very hard to replicate.
Yeah, companies like, for instance, REA Group, Pro Medicus, Netwealth, Hub24, and Premium, they are already integrating AI into their search, imaging, analytics, and platform flows, while continue to grow quite strongly. Their edge comes from unique data, mission-critical use cases, and tightly integrated ecosystems, which should help defend pricing and margins.
And Tech One and Objective Corp sit in a similar camp. Government compliance and regulated content management systems are sticky, data-rich, and difficult to remove.
Yeah, that's right. And Bravura Solutions, that's a similar company, which is earlier in its turnaround. They offer the background software for those wealth managers and superannuation funds. But AI offers an opportunity for Bravura to modernize through automation and digital advice. But it also increases competition, especially if leaner players move faster.
And for the insurance brokers like Steadfast and AUB Group, AI is more likely to pressure margins in retail and SME segments, with Steadfast probably more exposed than AUB. Both are investing in technology to automate simple policies and focus brokers on complex risks.
But in short, Matt, AI isn't eliminating these businesses. It's separating those with embedded systems, stringent regulatory frameworks, and proprietary data, which most of our star stocks do have. Thanks, Matt. That's all we have time for today, and appreciate your insights. I know how busy reporting season is for you.
Great to be joining you again, Kien.
Until next time, have a happy, healthy, and prosperous week ahead.